It's almost midnight, and someone is staring at their banking app. The number on the screen reads $5,000, the exact same credit card balance they've been paying down every single month for 2 years. Not lower, not higher. The same number, month after month, no matter how many payments go through, they know they've paid something. The statements prove it. Dozens of them, sitting in an email folder, each one showing a payment made on time. So why hasn't the number moved? That question, quiet, confusing, a little bit humiliating, is something millions of people are asking themselves right now, at this exact moment, on this exact kind of app, staring at this exact kind of balance. And almost nobody explains why it happens, because the honest answer isn't really about spending habits or willpower. It's about a system engineered so that most of what you pay never actually touches what you owe. Most people don't even remember the moment their card debt actually started. It's rarely one big purchase. It's usually smaller than that. A car repair covered just this once, a month where the paycheck came a few days late and groceries went on the card instead, a small emergency that felt temporary at the time. Credit cards are built to make that moment feel painless. There's no visible cash leaving your wallet, no immediate consequence, just a small swipe and a receipt. That ease is exactly the point. The real cost doesn't show up until weeks later, on a statement, by which time it already feels like part of normal life rather than a decision that was made. Here's the misconception nearly everyone carries into their first credit card. Paying the bill means paying down the debt. It doesn't, not the way most people assume. When you make a payment, most of that money isn't reducing your balance at all. It's covering interest that quietly built up since your last payment. What's left over, often a small fraction of what you sent in, is the only part that actually shrinks what you owe. The rest just keeps the debt alive for another month. This is exactly why that $5,000 balance can survive 2 full years of paying it off without moving an inch. The math isn't broken. It isn't a mistake and it isn't bad luck. It's working precisely the way it was built to work. So let's actually watch what happens as that balance grows, because the trap doesn't get worse in a straight line. It gets worse exponentially, and almost nobody sees the full shape of it until it's already too late. At $5,000, a typical minimum payment sits around $125 a month. At a 24% annual interest rate, roughly $100 of that goes straight to interest before a single dollar touches the principal. Pay only the minimum, and it takes over 15 years to clear the balance completely. And along the way, you hand over more than $7,000 in interest alone, more than the original debt itself. You'll have paid for this debt twice over by the time it's gone. Now push that same math to $20,000. The minimum payment climbs to around $500 a month, but the interest portion climbs right alongside it. Roughly $400 of every payment goes to interest at the start, sometimes more. Stretch that out at minimum payments, and the payoff timeline barely improves at all, while the total interest paid balloons past $28,000. You've quadrupled the debt, but the pain isn't 4 times worse. It's closer to being trapped indefinitely, because the interest is now large enough to nearly cancel out whatever progress the payment was supposed to make. At $50,000, minimum payments run around $1,250 a month. Nearly $1,000 of that is interest in the early years. Even someone earning a solid, comfortable income can find that monthly number eating a serious chunk of their paycheck, while the balance itself barely shifts for years at a time. This is also the point where a second card often enters the picture. One card to cover the gap left by the first, quietly doubling the exposure to the exact same trap. This is the level where people often start avoiding their statements entirely, because opening them just confirms what they already suspect, that nothing is really changing. And at $100,000, a number that sounds extreme until you realize how easily medical bills, a business setback, a divorce, or simply several years of minimum payment drift can get someone there. Minimum payments can run $20,500 a month or more, with the overwhelming majority of it disappearing into interest before it ever reaches the principal. At that level, someone can pay tens of thousands of dollars over several years and watch the principal barely move, because the interest compounding each month is nearly as large as the entire payment itself. It stops feeling like debt repayment and starts feeling like rent paid to stay in the same place forever. Here's what makes this even harder to see coming. 2 people can earn the exact same salary and end up in completely different positions, purely based on how their card balances behaved in the background. Picture 2 coworkers, both earning $65,000 a year, both starting with 0 credit card debt at the same job on the same day. One of them treats the card strictly as a convenience, paying the statement in full every month without exception. The other lets a small balance carry over during a rough month, tells themselves they'll catch up next paycheck and never quite does. 5 years later, the first coworker has paid $0 in credit card interest across the entire 5 years. The second, starting from what felt like a manageable few $100s of carried balance, has quietly accumulated $8,000 in debt and paid roughly $9,000 in interest along the way. Nearly the entire difference between a modest raise and a significant one. Gone to a lender for two people who earned identically the whole time. Same income, same job, same 5 years. One walks away with a clean slate. The other walks away having effectively worked several extra months purely to fund interest payments on money that's long since been spent. That's the part that should genuinely alarm you. The trap doesn't scale the way the debt does. Going from $5,000 to $100,000 isn't 20 times harder to escape. It's closer to becoming mathematically nearly impossible without changing your entire approach, because at higher balances, the interest generated each month starts approaching the size of the payment itself, leaving almost nothing behind to actually reduce what's owed. The bigger the number gets, the smaller the fraction of your payment that's actually working for you. If you've ever felt like your credit card balance has a mind of its own, refusing to shrink no matter what you throw at it, that feeling is accurate. And it's exactly the kind of hidden mechanic this channel exists to expose. Subscribe if you want to keep seeing the parts of the financial system nobody explains clearly. So why does the system work this way? Because minimum payments aren't designed to help you get out of debt quickly. They're calculated specifically to keep you paying as long as legally possible while maximizing the total interest collected along the way. Card issuers make far more money from someone paying $125 a month for 15 years than from someone who pays the full $5,000 off in 6 months. The minimum payment isn't a helpful suggestion, and it was never meant to be responsible advice. It's a number engineered around a business model, and that business model depends entirely on the debt lasting as long as possible while still looking manageable enough that you keep paying without alarm. This is why the entire structure can feel like it's working against you. Because in a very real sense it is. The interest rate, the minimum payment formula, even the order in which payments get applied to purchases versus fees and existing balances, all of it is built around the same underlying goal. Keep the balance alive for as long as the borrower will tolerate it. Understanding this changes something important, though, and it's worth pausing on before we talk about how to get out. Because a huge part of why people stay stuck in credit card debt has almost nothing to do with math. It's psychological, and it's rarely talked about, honestly. Shame keeps people from looking closely at the actual numbers, because looking closely means confronting exactly how bad it's gotten. It's easier to make the payment on autopilot and never actually calculate the real payoff timeline, because the real timeline is often frightening enough to avoid entirely. Avoidance feels safer than facing a balance that seems to be growing regardless of effort, even when the truth is usually more survivable than the fear of finding out. And here's the part that traps people the longest. Paying the minimum every single month feels responsible. It feels like you're doing the right thing, because you're never late, you're never missing a payment. Your credit score isn't tanking, you're technically handling it. But handling the minimum and actually escaping the debt are two completely different outcomes. And nobody explains clearly that doing the first almost guarantees you never reach the second. The system is quietly rewarding the exact behavior that keeps you paying the longest and calling it responsibility. There's also a quieter fear sitting underneath all of this. The worry that paying more aggressively, or calling the card company, or looking too closely at the numbers will somehow hurt your credit score. In reality, it's usually the opposite. A high balance relative to your credit limit, something called credit utilization, is one of the biggest factors dragging your score down in the first place. Paying it down faster typically helps your score climb, not fall. The fear of making things worse often keeps people frozen in exactly the pattern that's already hurting them. There's also a broader cultural piece to this that rarely gets said out loud. Carrying some credit card debt has become so normalized that it barely registers as a problem until the balance is already large. Surveys consistently show most cardholders carry a balance month to month, which means the person staring at their banking app at midnight isn't an outlier making some unusual mistake. They're the statistical majority, quietly assuming everyone else has this figured out while feeling like the only one who doesn't. This isn't a character flaw, and it was never a sign of weak discipline. It's a completely predictable response to a system built to reward the appearance of responsibility while quietly working against the actual goal underneath it. Once you see that distinction clearly, the shame usually starts to lift, because the problem was never that you weren't trying hard enough. It's that trying the way the system encourages you to try was never going to get you out. So here's what actually does work. And the good news is that the math flips just as dramatically in the other direction once you change one single thing. How much you pay above the minimum. Take that same $5,000 balance at 24% interest. Instead of the minimum payment stretching it out for 15 years, pay $250 a month instead of $125, and the entire timeline collapses to roughly 2 years, with total interest dropping from over $7,000 down to around $1,200. Same debt, same interest rate, same starting point. The only variable that changed was the size of the payment, and it turned a 15-year sentence into a 2-year one. That single shift is often the difference between a debt that never ends and one with an actual visible finish line. There are 2 proven methods for tackling debt once you're ready to pay above the minimum, and they work in genuinely different ways. Say someone is carrying 3 balances at once: $2,000 at 26% interest, $3,000 at 22%, and $1,000 at 18%. The debt avalanche method targets the $2,000 balance first, since it carries the highest rate, throwing every spare dollar at it while paying only minimums on the other 2. Mathematically, this saves the most money overall, since it eliminates the most expensive interest first and stops that specific bleeding sooner. Once that's cleared, the extra payment rolls onto the next highest rate, and so on until everything is gone, usually with the lowest total interest paid of any approach. The debt snowball method instead targets the $1,000 balance first, regardless of its 18% rate being the lowest of the 3, because it's the smallest and can be cleared the fastest, building momentum through a quick, visible win before moving on to the next one. This approach costs slightly more in total interest over time compared to the avalanche method, but it tends to work better for people who need to see real progress quickly, to stay motivated and not give up halfway through months of slow grinding against a large balance. Neither approach is wrong. The right one is whichever you'll actually stick with for the months it takes to work. A balance transfer card can also change the math dramatically. Moving high-interest debt onto a card offering 0% interest for a promotional period, often 12 to 18 months, gives every single dollar you pay a chance to actually reduce the principal instead of vanishing into interest the moment it lands. Someone carrying that $5,000 balance at 24% could move it to a 0% card, and suddenly the entire monthly payment goes toward the actual debt, turning what would have taken 15 years into something that can realistically be cleared within that promotional window, assuming the transfer fee is factored in and the payments are kept consistent. Most transfer fees run around 3 to 5% of the balance moved, which is worth calculating against the interest saved, but on a high-rate balance, that fee is usually recovered within the first month or 2 of 0% interest alone, and it's worth simply calling your card issuer and asking for a lower rate. This sounds too simple to work, but a surprising number of people who've paid on time for a while can get their APR reduced just by asking, since keeping a paying customer on the books is usually worth more to the issuer than losing them to a competitor or watching them default. It costs nothing to make the call, and the potential savings, especially on a larger balance, can be significant enough to be worth the 10 minutes it takes. Even a modest reduction, say from 24% down to 18%, meaningfully shifts how much of each payment actually reaches the principal instead of disappearing into interest, without requiring a transfer, a new card, or any change in spending habits at all. None of these options require earning more money. They require redirecting money that's already being spent on interest into actually reducing what's owed, which is exactly the kind of shift that turns an unmovable balance into one with a visible, calculable finish line instead of an open-ended monthly obligation with no end in sight. Go back to those 4 tiers from earlier and watch what happens once this shift actually gets applied. At $5,000, minimum payments meant 15 years and over $7,000 in interest. Double the monthly payment, and it becomes 2 years and roughly $1,200 in interest. A debt that used to outlast a car loan now clears faster than most gym memberships get used. At $20,000, minimum payments meant a payoff stretching well past a decade with over $28,000 in interest. Paying an extra few $100s a month, combined with targeting the highest rate portion first, can cut that timeline by more than half and save well over $15,000 in interest along the way. At $50,000 and $100,000, the same principle holds, just at a larger scale, The exact same shift, the exact same math, simply applied to bigger numbers. The tool that traps someone at every tier is the same tool that frees them at every tier. Nothing about the escape route changes based on how deep the hole is. Only the size of the numbers does. This is really the entire point buried underneath all of it. The trap and the escape are built from the exact same mechanics. Interest doesn't care whether it's working for you or against you. It compounds either way. The only question that actually matters is which direction you've pointed it, toward a lender who benefits from the debt lasting as long as possible, or toward yourself, closing the gap as fast as the math will allow. Now picture that same person again, at midnight looking at their banking app. Same $5,000 balance, same glowing screen, same late hour. But this time, they understand exactly why the number hasn't moved, and exactly what happens the moment they change how much they send each month. The confusion is gone. In its place is a plan, not a hope that things will somehow improve on their own, but an actual number showing exactly when this debt disappears for good, and exactly how much sooner that day arrives the moment they stop paying only the minimum. If this changed how you look at your own balance, that's exactly why this channel exists. Subscribe, and we'll keep breaking down the parts of money nobody explains clearly.